BlackRock and Wall Street are not ignoring XRP. They're positioning to own it. While retail traders argue online, the world's biggest financial players are quietly laying their traps. In this video, we'll uncover how BlackRock's silence is strategy.
How about an XRP? I can't.
And why Wall Street's latest $280 million blockchain deal proves XRP's moment is here. Watch closely. Your financial future may depend on it. The world's largest financial titan is manipulating the narrative with reverse psychology. BlackRock's apparent disinterest in XRP may not be ignorance. It's a calculated move, one designed to make you doubt, sell, and hand over your future at bargain prices. BlackRock doesn't chase hype. They engineer cycles. First comes silence, calm, controlled, calculated. Then they plant doubt, letting fear creep in. And finally, the strike. A wave is accumulation when the market is exhausted and undervalued. We've seen this before. Remember Bitcoin?
I don't have a strong opinion on Bitcoin.
I heard you say you thought it was a...
I said it was I believe it is an index for money laundering.
He dismissed it publicly, planting skepticism while quietly preparing. Fast forward, BlackRock's iShares Bitcoin Trust, IBIT, ETF, now holds over 3% of all Bitcoin in circulation. Tens of billions in assets. They mocked it, then they mastered it. So ask yourself, if they executed this strategy perfectly with Bitcoin, what's stopping them from running the same playbook with XRP? BlackRock understands something most retail investors don't. Headlines are weapons. One comment from a top executive can move markets more than 1,000 trades. A skeptical quote creates doubt, suppresses prices, and provides perfect entry points.
As you know, I was a skeptic.
Yes!
I was a proud skeptic. And I studied it, learned about it.
Today, XRP rumors swirl. Trillion-dollar liquidity pools, ETF whispers, partnerships with global banks. Publicly, BlackRock denies involvement, but behind the scenes, their digital assets director is seen at Ripple's Swell conference. Quiet meetings with SEC task forces. Trading volumes spike within hours of these non-events. If they truly had no interest, why so much proximity? It's a chess match. Hype draws attention. Denial shakes confidence. Accumulation happens while retail panics. This isn't conspiracy. It's strategy. It's exactly what they did with Bitcoin. XRP isn't just another coin. It's infrastructure. It's the bridge currency that could redefine global payments. Whoever controls liquidity at scale will dictate the future of finance. BlackRock knows this. They've studied Ripple's network, the XRP Ledger's reliability, and its compliance-ready design. Imagine selling your XRP now, convinced by doubt and headlines. Then months later, the ETF is approved. Ripple secures its US banking license, and XRP adoption explodes. The institutions who convinced you to sell now own your future upside. Don't mistake BlackRock's silence for surrender. It's venom, calm, patient, and deadly. The real question is, are you strong enough to hold your XRP while giants move in the shadows? And if you think this is just speculation, let's look at hard evidence. BlackRock's strategy isn't unique. Wall Street as a whole is already betting on XRP. A recent move by Guggenheim proves that XRP's future is not hype. It's happening. Earlier this year, Guggenheim Treasury Services, a division of the $340 billion asset management giant Guggenheim Partners, issued $280 million worth of commercial paper, not through banks, but on the XRP Ledger, XRPL. This wasn't a test. This wasn't a proof of concept demo. It was real, regulated financial paper, rated Prime 1 by Moody's, fully backed by US Treasuries. They skipped traditional clearinghouses and chose XRP's network for settlement. Why does this matter? Because commercial paper is the backbone of short-term corporate financing, a trillion-dollar market. If a major Wall Street firm is confident enough to move real debt instruments worth hundreds of millions through XRPL, it signals that this technology isn't a gamble. It's becoming the new standard. Ethereum and Solana weren't chosen. Private blockchains weren't chosen. Guggenheim chose XRPL for one reason: predictability beats potential. Ethereum is still battling scalability issues. Solana has uptime concerns. XRP Ledger, on the other hand, has processed 3.3+ billion transactions with zero downtime since 2012. It's built for institutions. It's built for reliability. And now it's proving it can handle regulated, high-stakes finance. Ripple even invested directly into Guggenheim's blockchain program to ensure liquidity and infrastructure support. This is a partnership, not an experiment. Commercial paper typically settles over days. XRP Ledger can settle in seconds. And that's a paradigm shift for global markets. If Guggenheim's $280 million deal is successful, and all signs point to yes, imagine a domino effect. 1. Instant settlements for trillions in debt. 2. Lower fees for issuers and investors. 3. Transparency and security built into every transaction. This isn't theory anymore. This is Wall Street adopting crypto rails, and XRP is at the center. So, what happens when other institutions follow? BlackRock, Fidelity, Vanguard, they're watching this play closely. When the first domino falls, the rest will wait. We've seen this sequence before. In 2020, institutions started piling into Bitcoin after years of skepticism. Headlines mocked Bitcoin, calling it a bubble, a scam, a toy for criminals. Meanwhile, ETFs and custody services were quietly being built. When the floodgates opened, retail was priced out. XRP is shaping up the same way. Regulatory clarity after Ripple's partial court victory. Institutional-grade partnerships across Asia, the Middle East, and Europe. The XRPL proving itself with real financial assets like commercial paper. We're watching a playbook repeat itself, only this time, the stakes are higher. So what should you do? This isn't financial advice, but it's a call for awareness. Don't let headlines and fear dictate your moves. Institutions thrive on volatility they create. If BlackRock and Guggenheim are positioning for XRP while publicly dismissing it, there's a lesson. Watch what they do, not what they say. For retail investors, this means don't chase pumps or panic sell during dips. Learn the tech, follow the money, and understand why XRP matters. Build your strategy, whether that's holding, buying strategically, or diversifying, based on data, not emotion. The XRP Ledger isn't a meme, it's infrastructure. It's not here to compete with Bitcoin's narrative as digital gold. It's here to move value, fast, cheap, and at scale. That's why central banks are piloting CBDCs on XRPL. That's why institutions are quietly accumulating. When the shift happens, it won't be slow. Just like Bitcoin in 2020, the price action will move before the headlines catch up. And by then, the liquidity will already be in institutional hands. Are you prepared for that moment? BlackRock isn't ignoring XRP. Wall Street isn't ignoring XRP. They're preparing to control it. This is your wake-up call to learn, position, and prepare before the narrative flips bullish. If you got value from this video, hit that subscribe button. Drop a comment with your XRP prediction and share this with someone who still thinks XRP is just hype. Knowledge is power. Stay sharp, stay wealthy-wise, and I'll see you in the next video.
I would also say on the beginnings of a ETF Bitcoin, we believe ETFs are a technology no different than Bitcoin was a technology for asset storage. We believe the next step going forward will be the tokenization of financial assets. And that means every stock, every bond will have its own, basically, QSIP. It'll be on one general ledger. Every investor, you and I, will have our own number, our own identification. We could rid ourselves of all issues around illicit activities around bonds and stocks and digital by having a tokenization. But the most importantly thing, we can customize strategies through tokenization that fits every individual. We would have instantaneous settlement. Think about all the costs of settling bonds and stocks. But if you had a tokenization, everything would be immediate because it's just a line item. And so we believe this is a technological transformation for financial assets. I believe, you want to talk about voting and voting choice and all the things. If we know every moment who is the owner of that stock and it's now time to vote, every individual who has ownership is identified and they can vote their own shares.
Is this the end of mutual funds?
I think, well, a lot of people, it's a wrapper. It's not the end of it, but I would say the dominant form of bringing products going forward will be in the form of ETFs.